I had to do something today that really hurt. I sold one of my absolute favorite companies, a key player in the AI race, and a stock that honestly I truly believe in for the long term. But sometimes just believing in the story, well, it's just not enough. And that's the number. £8,286 and 70 pence. As of this morning, that is the cash that's sitting in my account after I completely liquidated my entire position in Palantir. It's done. And this really gets to the heart of the single hardest question in all of investing, right? It's so easy to buy a stock you love. It is so much harder to sell that same stock after it's done incredibly well for you, even when all the data is telling you it's time to get out. So let me be crystal clear. I sold every single share, all 66 of them, from my tax-free ISA. The position is gone. So let's just walk through the exact data-driven reasons why I made this call. This right here, this is the core principle that forced my hand. I can love a company's story, I can admire the CEO, I can be excited about the tech, but I only invest my capital based on cash flow. And when the price completely disconnects from that cash flow, my system, well, it requires me to make a decision. And look, this decision wasn't based on some gut feeling or a scary news headline. It started with one very specific calculation that was basically screaming exit at me. The tool that I use is called a reverse discounted cash flow, or a reverse DCF. Now, instead of trying to guess a stock's future price, this thing asks a much smarter question. It asks, what absolutely incredible, best case scenario future is the market already pricing into this stock right now, today? So here's what I plugged in. I use the current stock price, a pretty standard 10% discount rate, that's what I require as a return, and a very generous 35 times terminal multiple on its future cash flow. The result that came back was, frankly, staggering. For Palantir's current stock price to make any mathematical sense, the company has to grow its free cash flow by 35 to 40% every single year for the next 10 years, without a single slip-up. This is the textbook definition of a stock that is priced for perfection. It means the absolute best-case scenario is already baked into the price. There is just no margin of safety left. None. And here's the most crucial point. If Palantir only grows at an amazing 30% a year, which would be incredible, the stock is still mathematically overvalued. So a single misstep, just one slower than expected quarter, and the stock could easily fall 40% or more just to get back to a reasonable valuation. That is a risk I am simply not willing to take. But you know what? It wasn't just my valuation model. A second, totally independent part of my process was also flashing this huge warning sign. My automated AI agent, Mary Jane, she flagged a big technical concern. The indicator she flagged is called the Relative Strength Index, or RSI. The easiest way to think about it is like a speedometer for a stock's price. It just tells you how fast the price has been moving up or down recently. Now, my system has a really simple rule built into it. If the RSI dips below 30, a stock might be oversold. Could be a bargain. But if it goes above 70, it's potentially overbought. It has entered what I call the take-profit zone. Palantir's RSI hadn't just crossed 70. It had surged past 80. It was deep into overbought territory. So you have this combination of being priced for perfection on the valuation side and being technically overbought on the momentum side. That was an unmistakable signal for my system. Take the profit. So I did. I followed the system. Okay, so this leads to a fantastic question that I'm sure some of you are thinking, Joe, if you sold Palantir for being too expensive, why in the world do you still own another high-growth stock like SoFi? Well, let's look at the math, because it tells a completely different story. Yep, my 882 shares of SoFi are still a core position for me. I haven't sold a single one. And the reason why comes right back to that same exact reverse DCF calculation we just did. Just look at this contrast. It's night and day. Palantir's price requires this almost impossible 35–40% growth rate. SoFi's price, on the other hand, only requires a very achievable 12%. But here's the real kicker. SoFi is actually growing at 25%. Palantir is priced for a future it might not even reach, while SoFi is priced for a past it has already blown past. And that right there, that is everything. One stock demanded perfection, with absolutely zero room for error. The other offers a huge margin of safety because its actual performance is already crushing the market's low expectations. That's the difference between a bubble and real value. I sold the bubble to protect the value I have elsewhere in my portfolio. So that brings us to the final piece of the puzzle. What happens to all that cash now that the sale is complete? Well, that 8,200 pounds is definitely not going back into Palantir, not even if the price dips tomorrow. It's been moved into my opportunity fund. It's now dry powder, just waiting to be deployed when the right moment comes. I'm keeping a close eye on a potential dip in Nebius, or maybe a chance to add to my core AMD position. You see, selling isn't about panic. It's about strategic reallocation. Ultimately, this is the job, isn't it? It is emotionally really difficult to part ways with a winning stock that you truly believe in. But building a system that's based on unemotional math, that's the only way to protect yourself from hype and to defend your compounding returns over the long, long haul. You know, going through this whole process really makes you think about your own rules. So I want to leave you with this question to think about. What is your number one non-negotiable rule for deciding when it's time to sell a winner?